Paul, we told you we're going to take a look at Costco, and you got a little fired up there. I can feel the heat from your undercarriage because you love Charlie Munger, Warren Buffett, and they love Costco, the wholesale place where you go and buy all the food. You see all the fat people and their fat, what are those those rascals, you know, and they got the big fat carts, and they're
got the hot dog.
They're just putting all the food in there. All the fat people go there and get all the food. I'm there as well. Why do you love Costco? And
it's not that I love Costco. First off, I do like Costco and Sam's Club. I'm just big fans of going into these stores with tons of. By the way, follow us on Instagram because it's awesome. But the reason Charlie Munger and Warren Buffett like Costco is they believe they don't know any company that spends more money and time trying to make the experience that great for their users. I think Amazon's probably up there for trying to make their experience really great for the user. But Costco, they love it. You'll see soon, they get a high return on invested capital. So Costco is a favorite of these two, but it doesn't mean you go overpay for it.
That's true.
Right, we're still trying to figure out here is how do you find an investment and figure out the right price to pay for it? So
we're trying to teach you how to separate the physical building of Costco and what they're selling versus their stock price. They may not be in line. We want to find those anomalies where the company's doing really great and the stock may not. That's our time to buy, and we'll show you if that is the time right now for Costco. Paul, let's look at what is the market cap for this puppy?
So Costco's a $200 billion company. They have a 5-year PE of 57.8. That's an X. We want it less than 22.5.
A little high.
Very high. They have a 13.5% though 5-year return on invested capital. That's a check mark. We want it over 9%.
This is pillar number 2. We're going to use our 8 pillars to look at the financials, folks. Follow along. Pillar number 2 is 5-year return on invested capital. We want that, as Paul said, greater than 9, which it is.
Now, one thing I'll say, Seth. High dividend yield, 2.8%.
Very nice.
But it pays out $5.7 billion a year in dividends. Their 5-year average free cash flow is 3.8. Last year was $7 billion. So we have to find out, is this a recent jump? Do they think this is sustainable? What's going on with that? Because, Seth, if they go back, last year was a shutdown year, right? Mm-hmm. So everybody had to go buy a ton of stuff from Costco. They had to go eat from home more. They couldn't go out as much. If this thing falls, if this free cash flow falls, that dividend's gonna be hard to pay. Right? So that's a concern.
They have 800 stores worldwide. Keep going, Paul. Let's look at profit growth over
revenue
the past.
Growth.
Revenue growth over the past is pillar number 3, and we want this same store, Paul, not so much opening new stores,
Right. So it's 123 to 186 with a check mark. But as Seth said, with any retail location, you want to focus on the same store sales. You can find that in a 10K, which is on our main page at the very bottom.
I'm pulling it up right now, actually.
You'll be able to find their same store or comparable store sales. You want to make sure that is going up with at least inflation or more. Pillar number 4 is net income growth.
Yep.
2.5 to $4.7 billion. So that's a check mark there as well. Good profit growth. Shares outstanding.
Pillar number 5.
Very, very small growth, but it is growth nonetheless. 438 to 443. We usually want that going down, but it is an expensive company, so I'm not as worried about that here.
If you're drawn to looking at these numbers, not just buying a stock and praying it goes up, you can have the software behind Paul right now. You can finally get a grasp on your investments. You can join the Everything Money community. Click the link below, and Paul can tell you what you'll get for it.
Guys, it's growing like crazy. You get the mobile app, so you get all the software on your phone. 8 pillars, 30 years of financial data, our stock analyzer tool, which you'll see at the end of the video. Exclusive daily content will be coming, 1 to 2 videos a day. Access to us. Big thing, Discord community with over 6,000 people that have access to it. You can talk about any investing in a very organized way with 6,000 people, all for 87 cents per day, guys. Less than a cup of coffee. You get all of this. Our competitors are 200, 235. Guys, 87 cents a day will lead you to hundreds of thousands, if not millions of dollars extra in retirement just by following a process that works.
Much like Costco, you have to have a membership to get access to all these awesome deals. And let's look at pillar number 6, which is total long-term liabilities divided by 5-year free cash flow, Paul.
Now, with a retail business, a lot of times they're going to capitalize their leases, which makes it look like long-term liabilities. So my expectation is this will be a hard one to beat. What we do is we take the 5-year free cash flow, $3.8 billion. We multiply by 5, and that is $19 billion. We want to see long-term liabilities less than $19 billion. Keep in mind, I don't know how they own their buildings. Do they lease them? Is it owned in-house? I don't know. So we go to the balance sheet. We want it to be less than $19 billion. Oh, 12.3.
Hey.
So we have a check mark there. So that's good. Remember, companies that have less debt are more likely to stay in business when times are tough. Correct?
Free cash flow growth is pillar number 7, Paul. You know this,
I love the free cash flow growth.
don't you?
So 2.15 to 6.9, check mark. But look, guys, last year was 4 billion. Previous year was 4 billion, jumped to 7 billion because of COVID. Just like when things are bad because of COVID, that you discount those. When things are good because of COVID, you have to discount that. So the 5-year average is 3.8 billion. To get a value, we multiply by 20 as a starting point. We have $76 billion value. It's currently 200.
Yikes.
So that is an X. Keep in mind, guys, this is a major X. You might sit there and go, it's not going to fall by 2/3. Well, guys, look at the PE. The PE is currently 43. It falls by 2/3. It's down to 14. That makes sense for a company like Costco. To me, this makes a lot of sense that the company is just overpriced. You go to our 8 pillars page. We have a lot of great stuff going on here, but the 2 major ones are valuations. That's just the way it is, guys. At the end of the day, every investment's the present value, future cash flow. We're going to put it, after Mo's done with this charts, we're going to put it in the stock analyzer tool, and we'll show you what you should pay for the stock based on the assumptions that I'm making.
Mo, this Costco was $311 this 6 months ago.
Was it really?
Yeah.
Yeah, this is astonishing.
Costco is a good example of a power stock, and like over the past 5 years, it's been a power stock several times. And what that means is the stock price is over all 4 major moving averages and making new all-time highs. Their volume, look how incredibly consistent it is. When was this? Yeah, this was 2020. So that bump of volume, everybody was saying, oh, we got to go to Costco and buy in bulk. But let's go over to the daily chart just so I can show you how to trade this. I mean, this is perfect. It moved through the sweet spot back here, and it's just had a great trajectory, and it's at those all-time highs going sideways. So to me, if you're in it, stay in it. You're doing great. I wouldn't even consider taking profits. Just stay in it. And if you get an engulfing candlestick like that and you're not in it, you can add to it.
We don't hear that very much, by the way.
No, we don't.
But this is a great momentum stock. So even when we do our turtle trading momentum, this would probably be one that would really have made you a lot of money.
Yeah.
Mo, can you zoom into this time, March 8th? If we would have followed our rules, we could have caught
right around
this
here.
Crazy. What did we miss the boat? What were we thinking back then?
Well, let me move into the entire sweet spot. So this was the whole move through the sweet spot. Let me get this chair out of the way. Okay.
Do you have a date back there?
Which one do you want? The day that it turned green?
Yeah, when we got some engulfing
Let's see.
candlesticks, sweet spot.
We probably would have added. I probably would have added on this day. This is April 5th. Probably April 5th is probably what I would have taken. What I would have started a position.
Why is that? Because that engulfing candlestick?
Yeah, this engulfing. This during that day, it was completely filled out like that. So I would have probably started a position there. This is when I really would have started a real position because I was comfortably in the sweet spot. Great engulfing candlestick, and then it just goes on from there. Probably would have added again on that one if I had to put anything else into the stock. But now it's all just sit and wait and let it ride at that point.
So that might sound like a bunch of gibberish, folks, but in the end, Mo has rules that he gives the bid and ask. And when the red line, step aside there, Mo, so when the red line crosses this 32 percentile, this stochastic on the bottom, and then we get our 3 days of engulfing candlesticks with the volume good, the bid and ask right in point, we would have bought and caught this run up. What the hell was I thinking, Mo? I didn't even know. Oh, I know
you
why,
weren't
Mo.
even paying attention
Jesus,
to that.
I was going to say, Mo, you just started in January, February. That's why I didn't. This is just astounding.
So another thing about this, you said the bid and ask. This one's a 9-cent difference. Because this is a $460 stock, I'm okay with a bid and ask difference of maybe like 5 cents. I always say 1 to 2 cents, but the higher the stock price, I'm okay if there's a little bit more spread in there, but be reasonable about it. Don't go and have a 50-cent spread or something like that.
Yeah, you need that bid and ask tight, Mo.
Yeah.
And speaking of tight,
as possible.
tight as Paul's butt cheeks, he's been doing squats lately. Let's head over to
I don't
Paul.
do squats. Do you do squats?
I did them a couple days ago.
Is it the thing when you're doing the belt
and I
thing?
can't walk now, so I did 2 sets of kettle swings, and I'm hurting. Paul, this is a stock analyzer tool. You know this. You made this software. This used to be your old Excel sheet, and what it does is basically tells us, let's make some assumptions and see what we should be paying for this company. It seems overpriced at the moment.
Everything is about assumptions, guys. The future is unknown. We have to make assumptions. My view of the world is I want to make conservative assumptions and see when the market has mispriced that. So I'm going to factor revenue growth in, assuming I want to do this one, 2, 3, and 4. I'm assuming no more opening of stores because the stores will just help. But I want to assume there aren't any open stores. I want to look at the company individually. Share change, basically the same, but I'm still going to put 0.3, 0.2, 0.1. Profit margin and free cash flow margins, basically the same, so that's good. Now PE. They do have a high return on invested capital, so I'm willing to go higher on the high end. But On the low end, I still want to keep it around 12. So I'm doing 12, 15, 18 on both PE and price of free cash flow. And then desired annual return, 15, 12 and a half, 10. I hit the analyze button. Look at this, all red, Uncle Seth. We're looking at basically $100, $110 stock in the mid-range to make 12.5%. That's a big drop, I get it. Oh, it's never gonna be that. Then you know what, in my opinion, you just move on. Remember guys, it's not your job to just force a buy to happen. Now let's look at it this way. What would I have to do revenue growth-wise to even get the justification for today's pricing? I'm changing from 2, 3, and 4% to 10, 15, and 20% revenue growth. It still doesn't hit there. We're still at the $200 a share. Still has to fall by over half. That's my point, guys. That is my point. Because guess what? When they open more stores up, they still have to take on debt or use cash, something like that. It's not just a by itself. Now, granted, let's go to 20, 25, and 30% growth, which they've never had in the last 10 years. We finally get one stock price, finally, that says you can buy it. And it's the very highest of all high stock prices. So guys, I think you're seeing from this that Costco is just an overpriced company right now. Now, why do Warren Buffett and Charlie Munger have it? They just don't sell their stocks. They just want to ride it out with good companies. They're just not going to sell it. I have to look back on when they actually bought the stock, Seth, but it probably was many years ago.
Yeah, Paul, just in 2015, this was a $142 stock. And if you look long term, it had a nice gradual increase, and now it's just exploded the past 3 years. So.
Yep. So guys, be patient. Your job is to be patient. Find the right stocks at the right prices. That's way more important than anything in the world in investing, is paying the right price.
That's our take on Costco. Join the Baynass. You can trade it with Mo. Join the Everything Money community in the link below, and we will welcome you in to our exclusive content Paul and I, Mo, are giving you. And let's make disciplined decisions out there, and our software will help you. So thanks for watching. Fondle the thumbs up on the way out.
And like us on Instagram. Follow us on Instagram.
That's true, Paul. See you next video, guys. Appreciate it.